Okay, hello everyone, and welcome to our May 2022 7 Investing in Focus. This is one of our deep dives into one of the particular market segments that we're very interested in. I'm very excited today to welcome you to Luke Hallard, who's our lead advisor here at 7 Investing. He's going to be giving today's presentation. Luke, you have found one of the best performing segments of the entire stock market, which seems to be an opportunity for investors going forward.
Simon, you and I know what this sector is. It might be a surprise to some of our listeners, though. What is one of the market's best performing sectors of the last couple of years? Software as a service, SaaS. Today, we're going to do a bit of a whirlwind tour through what is software as a service. We're going to look at what's happening in the stock market to SaaS companies. We're going to take a look at some interesting business metrics. So if you're doing your own investment research on SaaS companies, give you a couple of tools you can look at to understand the quality of some of those investments potentially. I've then got 3 great software as a service investment ideas for you. I'm looking forward to it. Should we get into it?
Absolutely, Luke. And just a reminder for anyone who's unfamiliar with 7 Investing, Luke is a lead advisor with our team, which means every month he's giving his best idea in the stock market. We issue all of those as recommendation reports and we present them to our members. If you are interested in 7 Investing, our website is 7investing.com or 7investing.com/subscribe if you'd like to get started and see even more of Luke's favorite ideas. So Luke, I'm going to hand it back to you. Let's learn about software as a service.
Great stuff, Simon. Well, what is software as a service? So they're a really special kind of tech company, software company. And what's special about them is they offer their products to customers through the internet for a monthly subscription, basically a pay-as-you-go model. It's a bit like leasing software. This is actually a really interesting model as an investment. If you think about old-style software companies, and I used to work for a big bank, and actually I led the purchase on a couple of really big software deals for us. The majority of the revenue for that software company is captured at the time of the purchase. Maybe you buy like a whole bunch of licenses that are going to run for 5-10 years. And then the software company is going to collect small revenues, kind of maintenance fees along the way. Software as a service is really different though. Almost nothing typically upfront. You lease the software, perhaps on a per user or per transaction basis, and the revenues are highly recurring. It's a fantastic business model, actually. Very high gross margins. These companies hang on to a lot of the money they earn because they're actually quite capital light, just like they're leasing their software to their customers. They're actually renting their infrastructure and their hardware from the big hardware platforms like Amazon's AWS, Google Cloud Platform, Microsoft's Azure. They have really low costs up front to mobilize, and it means they can scale really quickly. Now, the really interesting thing about software as a service companies as well is they have what's known as a land and expand business model. Now, again, if I go back to my old days evaluating big software vendors, we would engage at a global level. Typically, if it was a really big deal, you'd have to get procurement on board, and often you go up to the CTO if you're buying a piece of software to get their endorsement to the spend. Well, actually, land and expand is a completely different model. The developer themselves, perhaps in a smaller company, can just put down their own credit card, buy a license, or even maybe a freemium, download the software, just get using it straight away. And if they like it, maybe it expands organically. And so in some interesting way, you have this kind of organic movement building for some of these really fantastic platforms. And often the procurement or the CTO are like the last guys to hear about it. They only hear about it when half the company is using this stuff already. That's a really interesting, almost viral model for these companies where their users actually become almost their sales force.
Absolutely. Developer movement and DevOps is kind of one of those bigger picture things going on, right? It's not so centralized as you said, it's coming from the top down. Growing organically is a great way to get buy-in from the people who will be using it the most.
Well, let's take a look at what's happened to some of these investments over the last couple of years. Here's their overall market performance. And we can see some really interesting happening here. This goes way back to, it looks like 2004 through 2022. Look at that green line. That's basically the average valuation of SaaS companies compared to the rest of the market. And look at something really interesting happened really in the last year or two. Now, we should note, let's take a look at this crazy y-axis, right? We're looking at 21 times growth at the peak from 2004 compared to the S&P and the NASDAQ, which are languishing down there at like 2 or 3x growth over that same period. SaaS companies almost 10 times the growth, but they've taken an absolute precipitous drop off in valuation just really in the last year and a half to 2 years. That's happened, I think, for two reasons. Now, as we all know, growth stocks have sold off for very good reasons that we know about. Supply chains are really struggling and impacted. Inflation and interest rate rises. Of course, also the horrible situation with war in Europe. Major factors that are impacting growth stocks. But actually, there's something else going on, I think, for software as a service companies. The world we live in today is kind of an era of higher expectations. When it really comes down to it, we expect things to be effortless. And if we rewind back to I suppose, let's call them first generation SaaS providers, they did all the stuff we just talked about on the last slide. They made it really easy to buy, install, and manage their services, kind of land and expand, get them into the organization. But actually, in some cases, they largely mimicked on-premise applications with the user experience. And it was just a cloud version of the thing you had already. Not all SaaS companies are created equal. And as well as being easy to buy and deploy, I think the best SaaS investments, particularly those that are targeted at smaller companies, have business models that are self-service and readily adopted by the end users. You want that organic growth. You don't want to have your salespeople and your consultants in there to help a customer come up to speed and grow their use of the product.
Luke, this is just a phenomenal graph. When you look at it and you think about it over a 15-year period, getting a 20x return, 2,000 return, it means for every $10,000 you put in, it turns into $200,000, even if you're investing in the entire sector. That is a movement. That is a huge win for any investors to think about it that much. And it just kind of shows how software as a service has become the new normal for all the reasons that you just pointed out in the software world. And I'm sure as you're about to show us in the coming slides, it seems like the right-hand side of that graph has been a reset of expectations. It's been certainly an interesting time right now for us to be reconsidering this sector again.
Growth stocks have sold off. We're in a bit of a bear market right now. And I want to weed out the best investments that have just gone down with the market from the ones that actually are suffering for very good material reasons to the way they operate. I think if you talk to any investor and you ask them to pull out one metric that they think is one of the most important things, then sustained revenue growth is really up there. Revenue isn't the most important thing on its own. Not all revenue is created equal. I'll give you an example. If I ran a small company, I could generate almost infinite revenues by selling dollar bills for 80 cents, right? Everyone's going to buy that and they're going to cycle their money through my organization until I run out of cash. It's not just good enough to be selling dollar bills. You have to do it profitably. And the framework Harvard Business Review took to this was to say good quality revenues are predictable, they're profitable, and they're diverse. So here's a couple of metrics you can use when you're assessing a company to see if it has those attributes of predictability, profitability, and diversity. So one thing I like to look at in predictability is something called DBNR, dollar-based net retention. And ideally, you want that to be over 120%. So what does that mean? That's basically how much revenue growth does a business generate without acquiring new customers. And if that number's over 100%, well, on average, your customers are spending more and more with you year after year. So even if you didn't add a single new customer, you're going to keep growing those revenues. Obviously, you have to consider churn of your customers too. Another good aspect, I think, to help you measure predictability of revenue is the customer lifetime value. How much money do you actually earn from a typical customer overall in their lifetime of their engagement with you? Got a little picture on the right-hand side of the slide here. Lifetime value is really the kind of red triangle plus the green triangle, and who knows where that green triangle ends, right? Could run on forever. So then if we look at profitability, when I talked about that selling dollar bills for 80 cents, well, a good way to measure that is through something called the gross margin or gross profit margin. That's kind of how much of each dollar you earn do you hang on to. That's really important because it means you're retaining your revenues in the company and they're falling down to the bottom line. It's money that you keep that you can use to reinvest into the business. Software companies typically have high margins compared to other industries. For a good SaaS company, you're looking for a gross margin over about 70 or 75%. You also want a low payback period. On my little diagram here, you can see that's the point where you've earned back the money it cost you to acquire that customer in the first place. There's no real guideline here, But the shorter the payback period, the quicker you're going to get to profit with that next customer. And that's going to help your business model. So what's the magic number? It's basically a measure of sales efficiency. What it's saying is, for every dollar of sales and marketing spend, how many dollars of recurring revenue do I create? So if I have to go and spend maybe $1 million to acquire my next 1,000 customers, if I can be generating at least $1,000 in recurring revenue from all of those on average, well, I'm kind of recovering that sales and marketing spend. And clearly, if you're a growth company, you're probably pumping a ton of cash into sales and marketing along with R&D to grow the company. So you're not necessarily looking for a company that's generating a magic number above 1, but you're looking for a number above 0.5, 0.75, shows you're on the right trajectory. And it also, if you're running the company, gives you an indicator as to when you should start really pushing the sales and marketing lever. And typically that's judged as being over about 0.75. And a fun little metric for SaaS companies particularly is something called the Rule of 40. And there's lots of different ways you could add this up. There doesn't seem to be an industry standard, but typically I've seen it calculated as your revenue growth percentage plus your EBITDA margin. Sometimes I've seen free cash flow margin, sometimes even gross margin. If you add up those two things, you want a number that's greater than 40. So what that's telling you is either you're growing revenues at a really good rate, or you're really profitable with the money you're earning, and ideally a combination of both. And then if we think about the last one of the Harvard Business Review's criteria for high quality revenue, is that revenue diverse? And really, that's no more complex than saying, do we have low customer concentration? Ideally, we don't want any single customer that's more than 15% of revenues. Because if you lose that customer or the business relationship goes sour, well, that could really impact you quite materially. And of course, the other side of that payback period and customer lifetime calculation, if you have low customer acquisition costs, the amount of money it's costing you to buy each customer, to bring them on board, if those costs are low, well, again, that's just going to help your model. It's that minimizing that red part of the triangle in my diagram on the screen. So we've taken a look at a couple of tools to help us assess the quality of a SaaS investment. Let's take a look at a couple of investment ideas. So at 7 Investing, we use a bunch of really great quality paid and free analytical tools for our stock research, particularly Y charts. It's really good. But there are a bunch of really, really great free tools out there on the internet. And one set of dashboards I thought I'd use for today's presentation, and they're out there available to all of you, are from Meritech Capital, meritechcapital.com. And they give a really nice intuitive way of looking at the whole software as a service market and comparing investments. Now, here's an extract of their highest growth software as a service companies that they're tracking. And I've used one of their tools literally just to filter down and say, show me anything in your tracking dashboards where it has over 50% revenue growth in the last 12 months. And if we think about the shape of this graph, we've got revenue growth plotted against valuation. So really you're looking for stuff on the bottom right-hand side. High growth, lower valuation. It's a good starting point when you're doing your research in this sector. So I've taken a look at this graph and a bunch of other metrics we'll look at in a moment. And I've picked out 3 companies that I think are really interesting investment opportunities, particularly right now if we think about the shape of that drop-off in valuations. And all 3 of these companies have faced quite significant valuation contraction, and so I think are quite attractive investment ideas right now. Simon, I know you know quite a lot about the first one I've got listed here, Snowflake, but let's just talk about who Snowflake are and what they do. They're a data warehouse as a service company, and they help their customers make their data easier to access and more valuable. So what does that mean? So actually, I used to be a database administrator. Back in the late 90s, one of my first technical jobs at HSBC was a Sybase DBA. And I thought we were dealing with a lot of data back then with all of our market data in these big databases. But today, the world has changed dramatically in the last 20 years. And today, well, millions of customers all over the world are gathering trillions of data points that are streaming in real time from billions of devices. That is just an impossible quantity of data to mine and draw insights out of using any traditional database or even really up until Snowflake, traditional data warehousing technologies. But the business challenge is still there. If you're dealing with this massive real-time streaming data, you still want to be able to pull insights out about it to drive future sales and profits. So that's where Snowflake's industry-leading capabilities become really vital to your enterprise. So they've provided this platform for data warehousing, and it's really a key tool now used by data scientists when they're dealing with ultra-high volume data in real time. And some interesting sort of SaaS-y things about Snowflake that make it quite an interesting company. They themselves can scale almost infinitely very, very quickly, just the nature of their architecture and the fact that they're cloud native. They sit on top of AWS from Amazon, Google Cloud Platform, Azure. So it's really flexible for a Snowflake customer to scale up their installation almost on the flip of a dime, put down a few more bucks on your credit card, you pay as you go, and start to mine those crazy volumes of data that might suddenly be piling in to help you manage your business. And it's a flexible business model. Customers pay based on the compute and the cloud storage they use. So there's that land and expand business model in action. Really easy for a developer to get started, prove the value in a tiny little use case, and then start selling it within the company. I will call out a red flag, actually, for each of my 3 recommendations, because you have to go deep and you have to really do your due diligence and understand these companies before you make an investment. And one thing, Simon, actually you picked up a little while ago when you were looking at Snowflake was they have really crazy levels of stock-based compensation. Apparently 50% of revenue is stock-based comp in the most recent quarter. That's a big number.
That's absolutely right, Luke. A lot of software companies pay with stock rather than cash because they don't have really, really deep pockets as they're in their growth phase. But I think that maybe with Snowflake, one of the reasons they are so well compensated is you're getting the best team that's out there, right? The co-creators, the co-founders came from Oracle. They were the infrastructure developers that came up with the whole idea of multi-cluster compute, have all the patents for it. And they said, hey, let's go out and create a company out of this. They hired Frank Slootman from ServiceNow. He's one of the best executing CEOs that's out there in terms of just getting things done. I think it's not a surprise why Snowflake's financial metrics look so well. Maybe also not so surprising that they're really willing to compensate their executive team as well as they have to.
Yeah, I think you can't complain about high levels of stock-based compensation if the executive team are really pushing the mission of the company. I think it can be a red flag in some companies. I think it's less of a red flag when the company's executing as well as Snowflake is. Let's take a look at my second interesting stock idea, and that's a company called Bill.com. And they're a financial services company. They have cloud-based software that simplifies and digitizes and automates your complex back office financial operations. What does that really mean? It's a SaaS platform to help small to medium-sized businesses better manage their books and finances. Helps you manage your cash flow. And actually, the secret is in the name, Bill.com. It's all about billing. One company's bill is another company's invoice, and those two things kind of pair up. So in business terms, that's considered to be accounts payable and accounts receivable. Well, Bill.com bring those two sides together, and they've got what's become quite a scaled platform that's really easy to use and is helping businesses see all of their cash flows in one secure and auditable place. If you're perhaps the CEO or the CFO, it's not just about seeing kind of today's reality of the books, but Bill.com allows you to overlay a calendar of payments and receipts expected in the future, so you kind of plot your business trajectory. They've done some really interesting stuff with their technology. I'm actually just scratching the surface with this 2-minute overview, but they've got some AI and machine learning capabilities to automate extraction of data off of paper, PDF invoices, and to pull that data in and try and optimize the workflow. And they claim that because of their automations, they're getting what's typically a 3-day-a-month cycle for the poor guy or girl who's doing all your sort of accounts payable and accounts receivable. They can get that down to 1 hour a month. So that's a material benefit for their customers. Makes Bill.com quite an attractive proposition. I will call out a red flag for this one as well. If we think about that DBNR, dollar-based net revenue retention, they might be DBNR constrained, because actually from a services perspective, they've got limited room to increase their subscription fees. I think at the moment you pay $69 per user per month. But once you're at that level, there's kind of nothing more to buy. So what the company really need to do to continue to grow and grow and grow, which is what you're looking for in a good SaaS investment, is not just grow their customer base, but as we'll see in a minute, their customer base is growing at an insane rate. They also want to increase the DBNA, the revenue from each customer. That means they're going to have to spend lots more money on R&D to build out additional services so they can continue expanding the wallet share for those existing customers they have.
Yeah, digital transformation, right, Luke? I mean, when you look at back office financial operations, that's not something that's super sexy out there, but my goodness, it's so necessary. And any business owner out there wants to be doing things more efficiently. This is a great opportunity for a company to figure out how to do that, not only more efficiently, but also smarter to manage a lot of that things. It certainly seems like it's a fit in the small businesses that are all across the world now.
Well, let's take a look at my third investment idea. And it's one that's been on my radar for a little while. It's a company called Monday.com. So actually, my credibility in this space, prior to joining Seven Investing, I was a program director for one of the world's biggest banks, ran big complex change programs, but basically it's like a project manager on steroids. And prior to being a super PM for HSBC, I ran something called the Workflow Center of Excellence, kind of business process management, workflow systems. And what Monday.com do is actually they bring these two capabilities together in quite an interesting way. And actually I'm using Monday.com myself to manage my own little dashboard of investment recommendations and to remind me where I need to do certain kinds of research and help me evaluate companies. But what they really do is they combine tasks, projects, workflow, automation, and they embed that into an organization with conversations between colleagues, content publishing, reporting, analytics, dashboards. Basically, it's a way of really quickly, as a non-technical user in an organization, building what can be quite complex workflows just to get stuff done. And it's not just about sort of internal facing, it's about engaging with your customers as well. So they integrate to almost every communications platform and other tech company you can think of out there, huge volume of integrations. So you can do real stuff in terms of triggering emails to customers, processing the replies when they come in. I'll give you an investment red flag for this one. They may not have a business critical product. Basically, it's a productivity tool. And although it's one that I found quite useful and I think has been adopted by their customers at a crazy rate of revenue growth, if companies really get cash constrained, it might be one of the things on the chopping block as they try and save money.
Makes a lot of sense, Luke. This is kind of a popular space when you're talking about workforce efficiency, right? We've seen Jira from Atlassian, in this space. We've seen Asana, which is one of the former founders of Facebook there. And now you've got Monday.com. It certainly is a trend that everyone's working remotely and needs to get on the same page when they're doing projects. This certainly seems like one that you want to look at the financial statements and see how the progress of the business is going to assess how it's doing against its competitors.
And actually a brilliant tee up to my next couple of slides. What I'd like to do is take a look at a couple of those financial ratios and just see how these three companies stack up. So let's do that. And I've picked out just a couple of sample dashboards from that Meritech Capital website. So here's Snowflake, Bill.com and Monday.com based on their dollar-based net retention. So you can see I've highlighted them on the graph. Snowflake, wow, 178% DBNA. That's crazy. They're almost doubling their wallet share from each customer in the most recent quarter. Bill.com and Monday, though, those are still good results, even though they're below that little median line. 120% DBNA is very healthy. Gross profit margins, remember, not all revenues created equal. Well, you want good profit margins, so you're retaining as much of that money you earn as possible. Monday, knocking it out of the park here with 90% gross profit margin. I think it's quite interesting. You mentioned Asana just now, Simon. Well, there's Asana next door to them on this graph at 90% as well. It's quite an interesting lesson, actually, in gross profit margins because they are different by industry. So clearly, running a collaborative work management platform is quite a high margin business. So we're probably going to see all of the companies in that sector operating in a very efficient way. So it's not that you could necessarily look at Bill.com's still a fantastic gross margin of 76% and say it's less efficient than Monday just means it's operating in a sector that is a bit more expensive in terms of costs of goods sold. But what you can do is use profit margin. And if you look at comparator companies, it's quite a useful tool to see how a company stacks up against its peers. The magic number, that sales efficiency, as a reminder, for every dollar of sales and marketing spend, how many dollars of recurring revenue do you create? We're looking for a number over about 0.75, which tells us that the company should be investing in sales and marketing. And here we go. All three of those companies meet that criteria. Bill.com, they're creating insane levels of recurring revenue from not so much sales and marketing spend. And then the rule of 40, the growth plus the profit should be over 40. And again, we've got all three of our companies absolutely killing it on that metric. And I will say, actually, diving behind these headline big numbers, it's primarily very, very high revenue growth that's driving the rule of 40 for these three. But I think they're in a healthy position in terms of growth and profit based on where they are in their life cycle. So that's why these three are my three very exciting SaaS investments to look at. Well, let's bring it into a couple of key takeaways just to wrap up today's session. And if you can find a SaaS investment that's really baked into the business model of your customers, well, you're going to be incredibly resistant if there's an economic downturn, because it's not something that a company can unplug in a hurry. If you're doing all your data analytics on Snowflake and you want to start saving money, well, that's probably one of the last places you're going to look, because you've lost such a significant capability in actually operating your business. But we have to remember, SaaS companies are typically valued based on their future revenues. So what we're looking for here are strong and sustained, high quality revenue growth. That's, for me, the most important characteristic of a successful SaaS investment.
Yeah, this is fantastic, Luke. I really appreciate, this inFocus presentation about one of the best performing sectors in the stock market, as you mentioned. It's maybe not a surprise why when you peel back the curtain and see all the most admirable qualities about software as a service companies, how they're embedded, how they've got continual recurring revenue, and that's just driving them to get even smarter. Just maybe my 2 cents to add too is it seems like when you're looking at any company in Northern California, in Silicon Valley, and the software developers that are up there, the best companies up there are really good at doing 2 things, and that is listening to their customers and then iterating quickly. They have a way to get feedback of what the qualities they want their software to do and then quickly spin them up. And of course, anything that's built in the cloud has a really, really easy way to iterate it. So it's some fantastic information about the industry as a whole. I really appreciate this presentation. I really like those 3 stock ideas. As a long-term investor, I'm actually excited about all 3 of them, especially when you show the financial metrics. Certainly are 3 that should be on our radar right now. I'm looking forward to looking into them even more in the next couple of years.
So, hey guys, thanks so much for swinging by and checking out part 2 of this video. I was really pleased to have a chance to share 3 quite exciting investment opportunities in the SaaS space with you. If you're interested in knowing more, I'd recommend swinging by our 7 Investing Discord. I'd love a chance to chat to you. We've got a fantastic, vibrant members and non-members area where there's really great quality conversation going on every day. But Sam, you're on the call with us today. Why don't you tell listeners about how they can get involved with 7 Investing as a subscriber?
Well, thank you, Luke, so much. This was fantastic. As I told you earlier, my portfolio is pretty much half and half SaaS and biotech. So I really wanted to listen to you and hear what you have to say and make sure I was making the right decisions with some of the stocks I've purchased, and I'm pretty confident in my choices. But we have a lot of SaaS companies on our scorecard at 7 Investing, and if you would like to check them out, we have a special promo code for you as a thank you for joining us today. So if you use promo code MAYINFOCUS at 7investing.com/subscribe, that will give you your first month of 7 Investing for absolutely free. So you can see which companies we recommended, use your own metrics to see if they're companies you want to invest in, or trust the domain confidence of the advisor who recommended that stock. So again, that is promo code MAYINFOCUS, and that is 1 month free of 7 Investing. So thank you all very much for joining us today. Luke, this was fantastic. I love getting the opportunity to listen to you speak, and I hope you all enjoyed it as much as we did. Have a great day, everyone.